Tax lien's been around for a long time. So again, a tax lien is a lien placed against a property for non-payment of taxes. In the United States of America, if you own a piece of property, you owe property taxes on it. If you don't pay your property taxes when they're due, you're going to get a certified letter from your county stating you're in default and a lien has been placed on your property. At that point, then in that particular county, you have the opportunity to be able to pay your property taxes off in what's called a redemption period or a grace period. However, what happens is the state conducts or government agency itself conducts tax liens for delinquent taxes on real estate in each and every county. We have over 3,000 counties in the United States of America. So when you default and they put that tax lien certificate together, basically is what it's called. When you default, they take your property tax debt and turn it into what's called a tax lien certificate. Then the county will take that certificate and sell it. They can sell to anybody who wants to buy it. Any investor in the world can invest in tax lien certificates. Again, we have over 3,000 counties in the United States of America, and anybody can invest in any tax lien certificate in any county, anytime, anywhere. Now, quick to your answer there, the difference between a property tax lien and a tax deed. In the United States of America, about half of the states are considered tax lien states. The other half are considered tax deed states. There's about 5 to 7 or so states that also will sell tax liens and tax deeds at the same time. Tax liens, again, a lien placed against your property for non-payment of taxes. So they will take it and turn it into a tax lien certificate, like I said, and sell it to an investor. You can earn 24 to 36% return on your money when you invest in a tax lien certificate. When do you get paid? You get paid when the property owner ends up paying their property tax. And as I said, in each and every county, in each and every state, there's what's called a redemption period, a grace period. For example, in Ohio, we have a 1-year redemption period, which means after I default on my property taxes and I receive that certified letter from the county stating that I've defaulted and there's a lien been placed on my property. They've taken it and they've taken the property tax debt and turned it into a tax lien certificate. If you're the investor, you come along and you want to buy that particular tax lien certificate, all you're doing is paying my property taxes for me exactly what I owe to the county. So if I owe $2,000 worth of property taxes, I don't pay my property tax. It goes into default. Then the county puts a lien on the property and they create that and they take that $2,000 property tax debt, turn it to a tax lien certificate. You then go to the county and you buy directly from the county that tax lien certificate for $2,000. So what you're doing is you're keeping cash flow running through the county, through the system, so they can pay the fire departments, the police departments, the road systems, the schools, taxes that need to be paid. That keeps cash flow running through the county. And as soon as you pay my property taxes for me by buying that property tax debt, then you own that particular certificate. So all you've done is pay my property taxes for me. When I end up paying my property taxes back, whenever that is, and like I said, in Ohio, it's a 1-year redemption period, which means I have 1 year to pay my property taxes back. Within that time period, I have to pay what I owe of $2,000 if that's the number that I owe. Plus, I have to pay penalties for paying it late, and I also have to pay the interest rate mandated by that state. So
Sure.
each and every state in the United States of America has a different interest rate mandated by that state. Ohio, for example, is 18% return, which is a good interest rate. So when I pay back the principal of what I owe for my property taxes of $2,000, I also pay the penalty for paying it late. I also have to pay that interest rate mandated by my state. Each and every single day that goes by that I don't pay my property taxes, I don't care if the stock market has crashed. I don't care if there's terrorism. I don't care if there's a tsunami. Whatever it might be in the world or even the financial market is completely irrelevant. You make money every single day that I don't pay my property taxes, no matter what happens in the market or the economy or the world. Every single day that goes by, I don't pay my property taxes. You're earning money every single day. So as soon as I pay my property taxes that I owe, the penalty and interest, I pay directly to the county. You, as a tax lien certificate investor, will never meet me. You'll never meet the property owner. You'll never meet anybody who owes their property taxes. You'll never have a phone call with them. You won't have an email with them. You always will only deal with the county. I only pay the county. So once I pay the county what I owe, my principal, interest, and penalty, then As soon as I pay that to them, they just email you the check of the principal of $2,000 that you paid for my property taxes, plus a penalty that I had to pay the county, plus the interest rate mandated by my state that I had to pay. All of that money goes to you right to your mailbox. The county does not take a piece of that. They don't take any of the penalty. They don't take any of the interest. They've already made their money. So basically what the county is doing is they're kind of factoring that particular property tax debt by keeping cash flow running through the system. So what you're doing is you're paying it for me, is all you're doing. So as soon as that's done, the county's happy. They got the property tax paid, everything's good. But as soon as I pay mine, then they just forward the check right to you. So you get 18% return per annum on the property tax debt that I owe $2,000 plus the penalties that I had to pay for being late. Now, that's tax liens. On tax deeds are a little bit different. In a tax deed state, if you don't pay your property taxes, then the county will simply just auction off the deed to your property, and they typically do it right online. They just will auction it off, period. You will then have a grace period to be able to go back and purchase that deed back, basically, by paying your property taxes. However, if you're in the position where you can't pay your mortgage or you can't pay your property taxes, the chance of you being able to pay all that back are pretty slim. So when it comes to property deeds, you can pretty much buy a property deed for about 25 cents on the dollar. So if it's a $200,000 house, you're buying that deed at an online auction for 50 grand. And that house is 100% yours at that point. Now we have to talk about the liens that are involved anyway. That might be additional liens on the property. So I hope that kind of distinguishes the difference between a tax lien and a tax deed. In a tax lien situation, you're going to get a return on your money. Typically, sometimes 24 to 38%, 36% return, different interest rates in different states of the United States of America. Ours is 18%, 36% out of Illinois, 24% out of Arizona, 24% per 6 months out of Texas, thanks to George Bush. But you're getting your return on your money. If you buy a property tax deed, you're actually owning the property itself for about 25 cents on the dollar.
So how does one go about finding these tax liens?
Well, that's all public record. They have, you go to any county, number one, and there's a book called Assignment of Purchase. You can just go to the county, and anytime that someone doesn't pay their property taxes, it obviously goes into public record. And it's called Assignment of Purchase, book about that thick. You can just go into your county recorder's office and you can take a look at the property taxes that are available. Typically, that's kind of the old school way of doing it, but you can just get right online and buy them. Get right online of that particular county. Like, for example, Maricopa County out of Phoenix, Arizona, 24% return on your money. Just get online and buy them. That's simple. And once you buy them, you'll receive a certificate. And that certificate, you're paying for somebody's property tax debt. You'll get the certificate from the county. And then you don't do anything at all. You just sit there and wait. And one day, as soon as the property owner pays their property tax plus penalty and interest, you'll get a check in the mail from the bank. I mean, from the county.
Now, what happens if, now this is clearly a distressed owner. So what happens if they don't pay during the redemption period?
Okay, very good question and phenomenal question. So here's how that works. Now, let me go back to the auction and how you get the properties, and I'll go to your redemption period question. In tax lien states, they have how do you get property tax or the tax lien certificate? You get them by going to typically an auction. And again, we have about 3,000 counties in the United States, and every single county will have a different auction in their county once or twice a year. You can, instead of going online and buying them, you can go to the county and bid on them right there at the auction. In Ohio, we have what's called bid down the interest. So the auctioneer will stand up and he'll say, here's one for $2,000 at 18%. Who wants it? Everybody raises their hands. Who wants it at 17.5%? 17, 16, 15. We will bid down the interest and start bidding on it. And then whoever's hand is left up, whatever interest rate it's bid down to, you own that certificate for that particular interest rate. There's also random bidding, where you'll go to the auction, a computer will just randomly spit it out, your name, and it's your turn to bid. And there are other states that have it's a bid up process. So in other words, they'll say, here's one for $2,000 at 18%. Who wants it for $2,000 at 18%? And everybody raises their hands. Who wants it for for 2,200, 2,500, 3,000 at 18%. So then you have to pay the county that much money. So that's kind of how they make their money as well during that process. Now, the redemption period is a great question.